Welcome to the Aramir Roundtable. Today is the 11th of August, 2021, and a special guest today, Wayne Klump. Wayne's running our sleep well portfolio and is doing great. A lot of people are pretty pleased with it. It's a great investor product to keep your account growing, but during the times when the market's being stressed, the sleep well is not as stressed, so you are sleeping well. But Wayne, we've known each other for a while now, and it's nice to have you here. You think a little bit differently than the traditional old options guy because you're doing ETFs and macroeconomics and all that. So you bring a nice perspective, and it's great to have you here. And I see we're going to talk about leverage today.
I appreciate it, Tom, and thanks for the amazing intro. And here, so everyone can see me and we can get going on this. So today we're going to be talking about leveraging leverage. This is a fun topic, and it's something that's somewhat counterintuitive in some ways. But before we start getting off on everything, we've got to go through the regular disclaimer. And Aramir or myself, I'm not broker dealers or financial advisors. We're not giving advice or anything like that. This is for educational purposes only, and past performance is not indicative of future results. And contact a financial advisor if you want to make any kind of decisions. All right. With that out of the way, Tom, do you have anything to add to that I might have skipped over a little too fast?
No, I mean, this is all on the recording, and if you want to read it, it's also at the bottom of any of our web pages. So yeah, that's basically it.
Perfect. All right, just a little bit of background. Thank you so much for the introduction, Tom. I'm just gonna kind of roll over just kind of a little bit of background just in case you're not familiar with who I am. My name is Wayne Klump. I have studied at the University of North Texas. We got a bachelor's degree. I studied business and behavior analysis. I worked as a strategy developer for a little while for a hedge fund. And then I now manage the sleep well portfolio here at Aramir. And I work with other money managers in strategy development and portfolio construction. And really my vision is just to make high-end wealth management really accessible to the masses. It's one of those things that I learned so much by being in the financial industry, and I learned so much with how the extreme wealthy really manage money, and how the money managers that actually manage their money are using things and how they think. And it's really just a fascinating subject, and I've really just kind of enjoyed it a lot. And I really wanted to kind of bring that to people because I think that there's a gap sometimes. So getting into leverage. So Mr. Charlie Munger, smart men go broke 3 ways: liquor, ladies, and leverage. Okay, we're starting off pretty heavy here, right? Warren Buffett, when leverage works, it magnifies your gains, your spouse thinks you're clever, and your neighbors are envious, but it's addictive. That all sounds pretty scary. And, it could be, rightfully so. But, we're going to try to take the veil off of leverage. We're going to kind of open it up, see what things are, and we'll kind of go through a few subjects. And those subjects are, first, we're just going to talk about what is leverage. What are the interesting results that Warren Buffett talks about? And more money with less risk. That's going to be a fun one. And then leveraging the leverage. All right. So what is leverage? I know this is like straight from Investopedia, but I figure I might as well throw it up here and then we'll just kind of break it down a little bit. So I'm going to read it straight off. So leveraging results from using borrowed capital as funding source when investing to expand the firm's asset base and generate returns on risk capital. Leverage is an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital to increase the potential return of an investment. All right, so lots of jargon there. If you're not familiar with finance, that was probably like, whoa, what's going on here? So first, the use of various financial instruments. So here at Aramir, and a lot of retail traders are pretty familiar with options by this point. So options are inherently leveraged, right? They're insurance products that leverage time, or that you pay for time in order to get a leverage ratio. Then also there's some leveraged ETFs. So they use futures, various instruments to be able to get leverage of the underlying. And then there are futures themselves, and then there's of course margin, right? So the margin is that borrowed capital right here. And borrowed capital is just in essence, we could just take out a loan from a bank and invest it, right? That we leveraged. So that's one form of leveraging. A margin from your broker is also leverage, right? And all of this is very important, that it's to increase the potential return of an investment. Leverage in finance is to try to get bigger returns, right? But there's some fun things with that, right? You already likely leverage. Almost everyone, especially in developed worlds, especially in the United States, we all pretty much leverage. So what are ways that we leverage? Credit card. Most of us have a credit card. When we take debt out to buy something, now typically these are consumer goods. You don't always have to use credit cards to buy consumer goods, but you're buying an asset with it. You're buying something with that debt. And now that asset, if you're buying a TV, probably loses value, right? So that leverage was really, poorly utilized. But it doesn't have to be something like a consumer product that goes down in time. It could be something that actually grows in time. A car is another form of leveraging, right? We're buying an asset, which is a car, and it goes down in value most of the time as well, unless you're buying classic cars or special editions and things like that, right? So we're already leveraging if you're using debt to finance a car. House, one of the biggest leverages that people use, right? If you're putting down 30% on a house, you're 3x leveraged on the housing market, right? So, home price might only go up 2% a year, but that 2% on your investment is actually much larger, right? You're going to see like a 6% return on your investment, various other things, right? I won't get into the nitty gritties, but you're getting leverage on the actual investment that you put towards the house. This is why some people can make quite a bit of money in the housing market, even in just regular inflationary times, not to mention the last few years, which that's just, some craziness. But then one of the largest leverages ever done, right, for anyone on their net worth, right, is probably college. A lot of us have college debt, or we took debt out to do college if we didn't have family that, or parents that paid for it for us. And that debt, well, your net worth, you might not have any net worth at the time. So when you're taking on a huge amount of debt to come in and go to college, you're investing in yourself as an asset, right? Because yourself is going to make more money over time. It's going to make more than that initial borrowed debt. And that might be getting squeezed nowadays, but that is in essence the risk, right? You're trying to take debt, invest in ourselves. We're buying ourselves as an asset, and then future it's going to pay us back, right? So there's 4 ways that we all pretty much probably already leverage. Now, the key thing in financial terms, right, is to use that money to actually have more power, right? Take that money and create more money at the end of it so that we can have a return. Well, so we're going back to Mr. Warren Buffett. When you combine ignorance and leverage, you get some pretty interesting results. So what are those interesting results? Well, let's start digging in. So now we're going to start looking at some charts and graphs. So this is starting the fun times, right? Okay, so here we go. I listed off, or I put 3 assets on here, which are leveraged ETFs. Now, first we have SPY, and then we have SSO and UPRO. Well, SPY is 1x, SSO is 2x, and UPRO is 3x. And what that means is for every percent up SPY goes, SSO goes 2%, and UPRO goes 3%. So there's our leverage, right? Now, they're doing this in various ways, but as far as the end user, this is an ETF that you can buy just like a stock, right? You just purchase so many shares and you just let it go, and it moves on a percentage basis of 3x of what the underlying is in general, right? So looking at this chart right here, Mr. Purple up here is our UPRO, light blue is our SSO, and then dark blue is Old Faithful, which is SPY. Now, we've got a nice gain of 33% over this little time period that I grabbed here, right? There's some COVID here, or there's some just little election worries and stuff like that, but the time frame is not really irrelevant. It's just saying 33% gain over this time period. Awesome. Well, we'd think 2x. Okay, well, 2x of that, somewhere probably around 65, 67. Okay, well, look at this, 75% for SSO. All right, 2x, right? We're a little bit higher than 2x, but we'll get into the kind of, where the math is going. There's a little bit of compounding that's going on over this time period. Then, okay, 3x. Well, 3x is UPRO. And UPRO, we get up to 125% return over this time period. It's awesome. All right. I mean, it's rocking. Like, that's what we want, right? That's what leverage is all about. But what's the interesting results, right? I mean, this is easy, right? We make 3 times as much money. If the S&P goes up 10%, we make 30%, right? Yeah. All right. Well, let's kind of look into this a little bit. What about a really volatile time period, right? So here's COVID right here, and this is just recent. That's why I use it as an example. But any kind of volatile time period where we get any kind of volatility spike doesn't even have to be this big, although this was a pretty large one, right? Now, same colors as before. UPRO up here had a return of 80%, whereas the underlying, which is the SPY, had 41%. Now, why isn't UPRO 3x? Well, that starts to go into how the math works for the 1% up is 3%, and then the 1% down is 3% down. Okay, so we're going to kind of look at another example, and then I'm going to get into just the little simple math that explains what's actually going on here and why 3x is not always 3x. So here's another example, and this is like literally if we invested right at the top of COVID. Bam, we're like thinking it's going to go to the moon, and we just straight up got it wrong. All right. And we're leveraged 3x, right? All right. Well, luckily, the market actually came back in this time period. SSO is doing 23%, SPY is doing 15%, but then UPRO is only up 12%. Here's another example of 3x leveraging underperforming. What is going on, right? And that's not to mention the fact that at 3x leverage down here, we drew down almost 75%. I mean, 75%. Holy crap. Okay, well, that's because we're leveraged, right? And that's kind of where the math is going to start getting into. So this is a little quick diagram just as a reference, right? And this reference is that as we increase our leverage, which is going to the right here, as we increase our leverage, we will increase our return and everything gets better, right? But then there's a precipice, right? And once we reach that precipice, as we increase our leverage, we start to lose money and or not make as much, right? And then as we really go too far, there be dragons, right? This is suicidal. This is not good, right? Death stars firing on our face, right? This is where you leverage so much that the volatility actually destroys your returns. Now that volatility, right? What is this volatility thing and how does it affect? The reason why we are looking at COVID and the reason why we are looking at those volatile times and how that affected that leverage portion, right, of our returns is because the amount of volatility with the amount of leverage that we have tells us where we are on this spectrum. And this spectrum can make you lose money in a short term and more so, right? So let's kind of make this a little bit simple. Now, before I populate this, right, it's going to be a lot of, it's going to be a little Excel table and there's going to be a lot of little numbers on it and everything like that. But we're just going to walk through it one by one. And it's actually just pretty simple. It's just a really clean, easy example. Okay. So we start out here at the top, which is just 0%. This is going to be, base level, right? And on 1x, we're going to go up 10% and we're going to go down 10%, up 10%, down 10%, up 10%, down 10%, and so on and so forth, all the way to the end. And then just to kind of make things nice and clean, we just get a nice up 20%, right? And we're going to go through a 1x leverage, a 2x leverage, a 3x leverage, a 5, and a 10, okay? And we're going to see how this mathematical dynamics of percentage gains and losses with these leverages affect just something that mathematically and intuitively we kind of think, well, we're back to break even, right? We go up 10% and we lose 10%. Okay, right? You know, no big deal, right? Well, let's see if that actually holds true and how that math is affected by leverage. All right, so a lot more numbers here. And before you start looking everywhere on the screen, which I'm sure you're already looking at the bottom here to see what I'm going to say here, let's just kind of zoom in here for a second, right? We start off at $10,000 on 1x, right? And we gain 10%. We're at 11,000. Yeah, woohoo, making money, right? And then we lose that 10%. Well, intuitively, we'd be thinking, well, aren't we back to break even? We gained 10% and we lost 10%, right? Like I just lost that 10%. Not quite, right? Well, now we have more money with the 10%. We now have $11,000 after the first gain. So when we lose 10% of that 11,000, it now puts us at a net loss. And this continues to go on in these equal ratios of 10 up, 10 down, 10 up, 10 down, 10 up, 10 down, right? It just falls and falls and falls. And then at the very end, we give us our 20%. So we actually break even. And I just did that with the 1x for various sakes. Now we're going to skip to the max end of the spectrum here, all the way, right? We've got our 10x variable over here. All right. So Warren Buffett said that our spouse thinks we're clever and our neighbors envy us. In the short term, we doubled our money. Woohoo! Leverage was awesome. Let's tell everyone about it. It's great, right? Bitcoin's going to the moon. All right, well, then all of a sudden that leverage blew us up. We're done. That was it. It was short-lived. We were awesome, and then we weren't, right? This is called over leveraging. You know, this is blowing up, right? That 10% up, 10% down, leveraged all the way to 10x, blows you up very quickly. And you can kind of see here in every leverage, it accelerates that amount of drag that mathematical principle of just 10% up and 10% down does when it's leveraged, right? So on none of the leverages do we ever get back to break even though at the very end, we get a 40% gain on the 2x, a 60%, 100% on 5x, and 200% on 10x. It doesn't really matter if we get 200% if we don't have anything, right? We blew up our account, right? It's gone. So this concept right here is really how leverage can give us some interesting results, right? This is what Warren Buffett's talking about, right? So statistically, we've got to watch out for how much percentage up to percentage down do we take, right? What's our risk? All right, well, numbers, right? You know, numbers and tables and spreadsheets, sometimes that doesn't always make sense to me. So looking at it on a graph is a little bit easier. So I've just got a graph on here, right? Now, what this is showing here, just really easy here, is our light blue is our leverage to 10x, right? You can see that we made a lot of money and we blew out everyone, right? We were golden, right? And then we weren't, right? Same principle. But you can see on everything, you can see this drag, and you can see how this drag is accelerated with leverage, right? And then you've got this 1x that basically breaks even at the end. Maybe it makes a little bit of money because we gave it a little pop, right? So this is the concept of how these interesting results start showing up when we start to leverage and things like that. So it's all, you know, pretty bad news and leveraging. And you're like, well, I thought I was here to, you know, make more money, right? And how is leveraging? This is like scaring me away from leverage. Well, at least sometimes it did scare me, right? All right, so enough with the bad and the slow, right? We all want to be going faster. We all want to be making more money. This is what it's all about, right? Okay, more charts. Ready? We all want to be going fast. We all want to be getting this 125%, but we don't want to be crashing. We don't want to be, you know, Ricky Bobby on a bad day, right? We definitely don't want 75% drawdowns, right? But I want the 125%, right? So in options land, you know, a lot of people hedge, right? And they're hedging with ratio spreads or puts or timed verticals or whatever. Well, the reason why they're having to do that, right, is because it's leveraged, right? Options are leveraged and they're leveraged a lot, right? So you have absolute risk in leverage. or in options. And in leveraged ETFs, it's the same thing, right? You can take massive drawdowns if you don't know what you're doing. And so those are those interesting results that Warren's talking about. So how do we go fast? How do we go Ricky Bobby fast, but, you know, not crash in the end, right? Well, you know, introducing the sleep well portfolio. For anyone that isn't already familiar with what the sleep well portfolio is, I've done some other videos on it. We'll have a link. There's the website up top that you can learn more about it. And I run the sleep well portfolio here at Aramir. And I run a 1x variant just to keep things baseline, but we're going to talk about, you know, how leveraging can be affected, how we can utilize some things, and how we can make things a lot better. In my own personal accounts, I leverage these things, right? So here we go. We've got the S&P down here in black, right? And that black, you know, it's like, okay, it's making money, it's everything like that. But, you know, the S&P has had some rough times. We have 50% drawdowns in 2008. You know, we've got some corrections in debt crisis, flash crash, and then not to mention the, you know, 20% correction or 20% in 2018. And then we had our 33% in COVID. Now, they've all rebounded from that, which is great. I'm so glad that it rebounded, right? But, you know, if it didn't, it sucks. And on top of that, you still had to deal with these drawdowns. So if you leveraged this product, right, just like what we showed in 3x leveraging like UPro, right, 75% loss in COVID. And then if you got a 50% drawdown in, you know, the 2008 recession and you're 3x leverage, you blow up. You got no more money. It's all over, right? So that's why you just can't raw leverage these things all the time, because the volatility will kill you, right? Well, the sleep well portfolio, give me just 1 second here. Well, the sleep well portfolio, you can see here, has less big drawdowns, right? We do have drawdowns. I mean, we're not perfect here or anything like that. But, you know, we have dips, right? And we have times of sideways action, right? And we have another dip here, and we have another dip, right? You know, so we have these little corrections, but what we don't have are those big ones that were in the S&P, right? And we keep these things stable. We'll get into the statistics a little bit and on the next slide. But what that is it starts to show a very different behavior, right? So a little bit of the statistics of what's going on in the sleep well portfolio versus the SPY. All right, so big drawdowns here. We just talked about this, right? 48% in the Great Recession, 33% COVID, right? Almost 34. And then in, you know, 2018, we had like a 19.8%, right? These big drawdowns, these are what blow you up. These are what give you margin calls. These are what give you, you know, big losses in your leveraged accounts and things like that, right? That you've got to worry about these. Or this is when you need to have hedging on if you're using options and trying to do verticals and trying to sell premium and stuff like that, right? So the sleep well portfolio, you know, these are the three largest drawdowns the sleep well portfolio has seen. Now, these can always be exceeded, just like we could exceed the 48% drawdown that happened in 2008. I mean, we saw like a 70 something in the Great Depression. That was a different time. You know, it was a different central bank. You know, we'll deal with that anyways. But, you know, we can see these large drawdowns again, right? And we can see them faster and all sorts of different things. But so far, we've had a little under an 11% for the sleep well portfolio. You know, 9, 8. So consistent, right? We're not seeing this 50, 30, 20, right? These massive differences, right? And that's because one asset, one raw asset like the sleep well or like the S&P 500, just you know, an equity based, even though they're blue chips, can have very large drawdowns, right? Small caps can have bigger, right? You've got commodities. There's different assets that can have these drawdowns, and depending on how much volatility they have, depends on what your leverage ratio can be. All right, so a little bit of downside standard deviation. So I look at risk in a way of what is my risk that I'm taking to the downside versus what am I getting for it, right? You know, a reward to risk ratio, right? And the SPY takes on, you know, on average, or a standard deviation, you know, almost 70% of the time, it does a negative 2.27% weekly downside, right? So that's how fast it goes down, right? On a weekly basis. And then to the upside, we've got about 1.91. So not terrible or anything like that, you know, I'm just saying, but it means that we're taking on more risk than we are getting in return on a weekly basis to just raw invest in the S&P. And that's because of these big drawdowns, and that's because of these flash whips and things like that. You know, that's partly because, you know, that's partly why we have skewed options in the S&P also, right? But, you know, puts are more expensive than the calls, right? Well, the sleep all portfolio kind of flips that on the head, right? Statistically, we have a 1.15% on our downside and a 1.39 on our upside. So because of how we diversify and when we diversify and the tuning of the sleep well portfolio to the macroeconomic environment, we can actually flip that reward to risk. And now we're actually getting more return for every unit of risk that we're taking on a weekly basis, right? Let's look at it one other way, right? So let's look at it to just a max drawdown, right? And you could replace the Great Recession with like COVID or something like that, you know, more recently, if you're like, well, we'll never have a Great Recession again, right? Or something like that. So you get a 10.48 average yearly return. Now, I usually use CAGR on my presentations, but I switched over to average yearly return because a lot of people just, they're used to hearing that. So that's what I just stuck in here, right? So over this little data set that I just grabbed the average yearly return. And it's a rough estimate here, right? You know, depending on what day you're grabbing and things like that. So 10.48%, roughly 10.5, right? With a max drawdown, of 48.76%. I mean, there's so much risk for just getting 10% a year. Oh God. That's rough. That's just a really rough deal, right? And you can see this over here, you know, 0.21, right? Okay, enough with that thing, right? You know, so the sleep well portfolio, right? We do with the whole setup and the way that we run it now, right? And I recently did a little bit of a change to it, but nothing dramatic, but it was actually able to enhance our results. But we've got 13.38%. Well, that's awesome, right? Maybe, you know, things can do better, right? But, you know, we did that with a maximum drawdown of 10.8. Way more. We're getting, yet again, we're getting more return per unit of risk in the same time frame, right? So on both elements, we have this, you know, this flip over of a reward to risk, right? And in that flip, it's literally 6x difference, right? From your unit of risk. The efficiency is so much higher, right? Because it's a really, really stable portfolio. It's a really stable way to make money. And it's adaptive to those macroeconomic environments. And it's got fractalized volatility measures and all this blah, 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 right? Okay. So in that efficiency is our opportunity, all right? This is where we can strike. This is where we can start doing some fun things. All right, here we go. But not all assets are created equal. We can leverage things, but, you know, each asset ebbs and flows and they act differently from one another, right? They're all moving and they all have different volatilities and things like that, right? And in the sleep well portfolio, we diversify amongst ETFs, right? And we change our weighting to them, right? So the amount of leverage we can do each one is going to be a little bit different. So the leveraging levels of the sleep well portfolio are as follows, right? So the 1x level of the sleep well portfolio is just ones all the way across, right? Where, you know, when we leverage, we're leveraged ones, right? And then 2, when I refer to a 2x leveraged sleep well portfolio, we're looking at 2x leverage SPY, 2x leverage TLT, 2x leverage gold, and then UUP is a 1x leverage. Now, you know, why is UUP 1x leverage, right? Well, UUP right now, you could leverage it with options, right? But the sleep well portfolio is trying to keep things simple, clean, easy to manage, and long only. So there's no shorts in the sleep well portfolio. So because we're not using options, right? And we're just buying ETFs and keeping things really easy and simple, especially for like, IRA accounts or, retirement accounts or something that doesn't have margin permission, things like that, right? The UUP, we're just going to leave it as a leverage of 1, right? Because we don't want to do any options or anything on that, okay? So from that point on, that's never going to get leveraged up. And that changes the dynamic of how much we can leverage other things, right? So, and then IWM are small caps and EM too. So 2X is pretty easy, right? But then when we start getting to 3X is where we start to notice a little bit of differences, right? So at 3X level, we're leveraging up SPY, we're leveraging up bonds, right? And we're leveraging up small caps, right? Well, there's a reason for that, how they interplay, what their volatility is, how their correlation is, things like that, how they ebb and flow over different macroeconomic cycles, right? But gold, right? Gold doesn't get leveraged up to 3X. Now, there's 2 reasons why gold isn't being leveraged up to 2X or 3X. I mean, first of all, gold is a little bit more volatile than some of these other assets. So when you start pushing it to 3X, it starts to get to that precipice that we talked about earlier. Now, also, the current ETF that's available for gold, while it's in existence, is there, the liquidity on it is also pretty low. So there's other risk factors in leveraging some of these ETFs too far, right? And whether they're there, right? And then now we've got another one, which is EEM, which stays at 2. Kind of the same story here. EEM is a more volatile asset than the SPY or than the IWM. And so when we start pushing it too far, it starts to degrade on the returns. And it has a fundamental relationship with the dollar, which is UUP. And we don't want to push that fundamental relationship too far. Okay. So that's all great, right? These are just numbers, right? But what are the symbols, things like that? Yet again, these aren't recommendations or anything, but I'm just showing these just so that we can have a clear understanding of these, right? So SPY has our 1X, and so we can see here on our 1X level right here that we've got all of our symbols, right? And like I said, they trade in and out just like a share, right? And then here's our 2X leverages and here's our 3X leverages, right? So that's how we'd be able to get into them. Instead of, if I wanted to go from 1X to 2X, emerging markets, I would just sell out of my EEM and then I just go get some EET. There are some subscribers that actually leverage, but they leverage using margin, right? And that's a different story. You're still using borrowed money to buy more shares, which is great. That's fine. You can do that. There is a cost to carry on margin. I'm not going to get into that today, but in essence, one way we can think about it is that to borrow that money to invest, we have to pay someone an interest on that borrowed money. So that expense is put into these ETFs, but it's a lot less than sometimes your margin. Anyways, like I said, we're not going to get too far into that. All right. So if we leverage the sleep well portfolio, what does that look like? So first I'm going to go into numbers and then I'm going to show the chart, right? So numbers first. So we're just going to kind of just look at everything based to the SPY, right? Where, everyone's so familiar with the S&P 500 that it's, it's sometimes good to just kind of have a baseline of where things are going and, what kind of risk we're taking. So a 2X sleep well portfolio gets us up to 20% max drawdown. It's more than what we had, but we're 2X, right? And also it's something to note just what we get. So anyways, our next largest drawdown, 18.8, and our next largest 18.7. So we're pretty steady. Yet again, pretty steady Eddie for the sleep well portfolio. That's kind of the name of the game. Steady Eddie, consistent baseline every year. Great. All right. Now downside standard deviation, right? So 2.27, 2.30. Whoa. By leveraging up the sleep well portfolio, we were able to get about the equal amount of downside. So we're taking on roughly on a weekly basis, we're taking on the same risk as the S&P. Now we're not taking the same risk on like a max drawdown sense, right? Because of these massive, 50% and 30% drawdowns. But on a weekly basis, we do have that same fluctuation in volatility, right? So what are we getting for that, right? That's kind of what we always want to know. Well, in the S&P, we knew that we were getting 1.91 for the risk. And now we're getting 2.75, right? All right, 1.20. in the positive notion. So we're getting more per the risk, per unit of risk, right? All right, so now what's the average yearly return, right? That's what everyone's always excited about. You know, what am I going to make? All right, well, Sleep Well Portfolio 2X does fantastic, right? 27.99. Heck yeah, it's doing what it's supposed to be doing. And on its max drawdown and its risk reward ratio, we actually are improving our risk reward. Now that's something that's just a little bit interesting here, right? We've taken a strategy that is stable and can be used as like just a kind of a haven, right? And we've leveraged it, but we've actually become more efficient by leveraging it. We've actually gotten more units of return. So remember that little dome chart that I showed that had our leveraging, right? You had that precipice level. We're climbing up that. So as we leverage up, we're actually becoming more efficient. So per unit of risk, we are getting more return as we leveraged up. Awesome, right? So just to kind of, throw a chart out here so that we can kind of see how things are going. Here's the normal Sleep Well portfolio in white. Here's the S&P 500 or SPY in black. Roughly by the end of this data set, which is, 2007-ish all the way to current, you got 4x your return on SPY, you get 5x your return on the Sleep Well portfolio. So, but you can kind of see here that over time, the S&P has been kind of catching up, right? Well, that's because it hasn't taken, a big long bear market or something like that. I mean, we've had some, flash crashes and we've had some COVIDs and pandemics and things like that. But, that stability has started to cost us in the sense that it's costing us because the SPY is actually gaining on us, right? Well, let's see if we actually equalize the risk on a weekly basis, but not on a drawdown basis, right? Not on the max drawdowns. We're not taking that 50% risk. We're not taking that 33% risk, but we're sitting here talking about on a weekly basis, right? We're kind of talking about how much we move on a weekly basis, how much return are we going to get in the same data set? Well, here's the 2x, right? Literally 25 times the amount of money we started out in this data set. 24 times. Okay, so that's just what it does. It's more efficient. You're going to get better returns. We're taking on still less risk on a max drawdown sense, right? And we're taking the same amount of risk on a weekly deviation risk, right? But we're getting more return, right? Every week we're actually going to be making more, right? Now, it doesn't mean that when the S&P is cranking, we're going to be cranking, right? It doesn't mean that when the S&P is going down, we're going to be going straight up, right? It doesn't quite match up like that because it's an adaptive portfolio. It's constantly mutating. It's constantly adapting itself to the macro environment. It's constantly adapting itself to what the assets are doing and how they're interplaying off each other. So how they're reacting is going to be different in every type of environment. The crash that we had in 2008 is different than COVID, right? And we've got to play differently for that. So, and this isn't a curve fitted model in a sense that, hey, look, this happened in 2008. We're going to do the exact same thing in COVID. No, that's asinine. And that's a good way to just blow up, right? What this is doing is it's saying, hey, these are what the assets are doing. I'm going to manage my risk according to how the assets are moving, how they're correlating, how their volatility is, how they're, what the macro environment is. Are we in deflation, inflation, things like that? And we're going to adapt for that risk environment, right? And then we're just going to let the assets play out the way that they do. And each crash or each correction is very different. But by leveraging it, we can actually get much more returns by using that stability that we're getting. All right, so we want more. So what about the 3x that we talked about? So I'm going to scan through the 3x a little bit faster here, but basically we're increasing our max drawdowns. Hey, we're leveraging, right? So we got a 26% max drawdown. And yet again, we've got pretty consistent 26, 24, 22, right? So these are the 3 max drawdowns. S&P hasn't changed, right? Same data set. Now we're taking on a little bit more risk for the weekly downside. Okay, this is getting a little bit heavier. And the weekly upside is getting bigger, right? So we are getting more units per risk or more units of return per risk than, like, say, the S&P. One thing to note though, now that we've gotten up to 3x and stuff like that, you can start seeing here now that our reward to risk, we used to be, 1.21 and 1.2, right? And now we're getting to 1.17. So we're starting to reach that where it's starting to roll over, right? On that chart that had the precipice on it, right? And that's because we're leveraging up and the volatility of it is starting to just kind of get into it a little bit, but we've got more to come, lots more to come, right? All right, so the sleep well portfolio on a 3x basis though, on an average yearly return to the max drawdown, you're looking at 37.24%, right? With a max drawdown of 26, that's a 1.41 reward to risk. So we're still gaining, we're still on the up climb, really strong on a max drawdown level. And that's because of that macroeconomic environment shift that the sleep well portfolio does. So on a statistical weekly basis, right, we outperform, and then also on a max drawdown in those long macro environments, those long bear markets, something like 2000.com, something like something like the 30s, anything like that, right? So really big points there. Okay, so it's really, it's one of those things that like 1.41 reward to risk on a max drawdown to your yearly return is just a whole nother animal compared to the terrible levels of risk that you have to take in the SPY. It's just one of those things that statistically in my mind, I have a hard time ever doing that, right? Well, here's the 3x graph, right? And a logarithmic doesn't always show it justice. So that's why I put how much, your money would be multiplied by the end of this, right? So, or how much in this data set. So you got 4x, 5x, 24x, and then now with a 3x, you're 56x, right? And you can do the math there. It's starting to get a lot, and compounding over time, it's pretty amazing. And you want to know how some people get wealthy in stocks, and how some people do it. I mean, this is the way it does it. This is why some hedge funds leverage and all sorts of things like that. Even Warren Buffett himself, I think he uses float from his insurance companies, and he's like 1.6x leveraged, right? So it's how the game's played, right? And this is how you make good money over time, and you can compound it and you can grow it, and it's liquid. And this is how, way better in a lot of ways. So we got the donut. All right. So we saw the opportunity. We saw that decreased volatility in the strategy that we're using, which is the sleep well portfolio. By having that diminished volatility, we found a way to attack and get that donut. All right. But we want more. There's always more, right? Okay. Well, let's put on our glasses. We can figure something else out, right? All right. Well, the sleep well portfolio has this very consistent drawdowns, and very consistent. It stays around a mean really well, right? And what do I mean by a mean, right? Mean, an average, a center point. If you're an options trader, you're probably familiar with mean reversion and selling premium when volatility is high, because volatility mean reverts, those types of things, right? There's all sorts of mean reversion strategies out there, RSIs, blah blah blah. So, well, it works really well if you have an asset that stays really stable inside ranges, right? Well, looking at the S&P 500, does it stay inside ranges, right? Is it staying steady inside of a range, right? Well, it's got these massive whips. Holy crap. I mean, it's just like you're fine and you're in these nice stable ranges, and mean reverting's great, while it's working, and then all of a sudden it just blows you out. So mean reverting, yeah, it works, right? I'm not saying it doesn't, right? But it does have that inherent risk in an asset that is unstable, right? Well, the sleep well portfolio is a lot more stable because it's constantly balancing its risks, right? So this gives us a little bit of an opportunity, yet again, another place to strike. That's this mean reversion element of it, right? When things are high, we can maybe play off for it to come back. When things are low, it's going to rebound, right? And in those stable environments, or in those stable assets, we're able to get a little bit of an extra edge. And we can do that with changing our leveraging as it goes around this mean. So one way of mean reverting is something that probably everyone's heard, which is just buy the dips, right? Buy the dip because it's going to come back, right? So we can do that in the sleep well portfolio. So I call this just leveraging under high water, right? So high water, if anyone's not familiar with high water is just where where the asset or the portfolio has reached a point that it has never hit before, right? So you're at a high water. You've now are into all-time highs, is what they like to say with the S&P 500. We just recently hit that in the S&P 500. So it's at a new high water, right? So when you come down underneath that high water is what I'm calling a drawdown, right? So you have a drawdown. And in those drawdowns, we're going to leverage up, right? So we have over here on our right side, we're just going to kind of focus over here for a second here. So our 1x, right, at high water, we're just going to be 1x leverage. No big deal. We're hanging out. We have minimal risk, right? Because we're at high waters. Things have been going well. We bounced back. If it keeps going up, great. We're going to make some good money. Everything's fantastic, right? When the sleep well portfolio is drawn down just a little bit, doesn't have to be a lot, right? Just a little bit of drawdown, which is 0.8 because it's so stable, right? We leverage up to 2x, right? And then when we get a pretty solid correction, right, in the sleep well portfolio, 6.7% down, we hit the hammer down because that's where the opportunity is going to be, right? Boom, we're going to leverage up to 3x. All right. And we're going to keep those leverages all the way until we come back to the high water, right? So in essence, how this works, right, is the asset is at a high water. We draw down, we go 2x. If it comes back above and we hit high water, boom, we go back to 1x. Great. Okay. And another scenario, we come down, we hit 2x. We come down further, we hit 3x. Now it's coming back up. We're still 3x, we're 3x, we're 3x. Boom. Right here, when we break out to new, we're at 1x again. Now, something to note that this is on the base sleep well portfolio. So when the sleep well portfolio is drawn down and then it makes a new high water, something very different, right? When we are leveraged up 3x, we're going to recover a lot faster, right? So we're going to be at high waters well before the sleep well portfolio has recovered because we had that leveraging point, right? But we're basing everything off of the sleep well portfolio. So when it gets back to high water, boom, we're up higher, we deleverage now, and we're kind of hanging out, right? Okay, so what does that do for our statistics, right? Did we get more efficient, right? All right, well, average yearly return, we're getting better than a 2x, right? And our drawdown is actually almost the same as a 2x, right? So by doing that, we've gotten even more efficient. We've gotten more cowbell, 1.45 reward to risk. Freaking amazing. All right. This is how we can use leverage in a good way, not leverage in an ignorant way like what Warren Buffett was talking about, which is mixing leverage and ignorance. You get some interesting results, and that's because, yeah, you can blow up. Now there's risk. I'm not saying that there's not, right? You are leveraging, right? So it's not like everything's perfect here. But on an efficiency sense, on a statistical sense, we can use it and amplify things in a smart way. A little bit more of the stats. So we're going to be now we're starting to quit. What about the drawdowns? Okay, then what about the downsides deviation? What did we do to our weekly downside deviation? Well, by de-risking in 1x and not being always leveraged all at the same time, we end up decreasing our downside standard deviation, right? Actually below the 1x. So we're between the 1x and the 2x. And that's because sometimes we're 1x, right? So we don't take all the heat all the time from being leveraged up, right? And we're rarely leveraged in 3x. roughly the statistics are, I think, like 26% we are 1x, and then roughly around half the time we're 2x, and then the rest of it we're at 3x, right? So it's not very often that we're fully maxed out to 3x, and a lot of the time, or a little over a quarter of the time, we're down there at 1x. And so that also has an inherent risk reduction, right? In the sense that, like, hey, if something crazy were to happen in the sleep well portfolio, there's a chance that we're not maxed out, right? We're not at a full leverage, right? And then our weekly upside, we retain all 2x upside. Ooh, yeah, look at that. So our statistics on a standard deviation sense to how much we take on a weekly basis versus how much we return dramatically goes up by using a mean reversion with leveraging, right? 1.47, instead of, as we leverage, we're going down a little bit, we're actually going to be first time going up. So all good stuff, right? And then, we're not even going to talk about Mr. Poor SPY up here. So what does that look like? All right, so the blue is the sleep well portfolio leverage under high water. Now, if you're just looking for just raw Monty, right, it's not quite, the 3x of just raw leveraging it all the time, but there's a lot of reduction in risk. There's much more efficiency and a less likelihood of having a hard hit to the portfolio, because not all the time are we leveraged to 3x, right? But we're getting more return than the 2x, and we're getting less downside standard deviation than the 2x, but we're getting more return, right? So in many ways, this is a much more efficient way to approach it, right? And so that's really where today this story ends, right? There's other ways to do this, and if you're part of the service, especially if you're following some of the newer stuff that I'm doing, which eventually I'll be releasing, that's going to be some really exciting stuff, because we're going to start playing with some of these different types of mean reversion strategies and kind of talking about them and fun things. So anyways, that is how we get to the piece de la resistance. That's the heaven, right? We finally not only just got the donut, but we got the whole freaking farm. Much more efficient, and we did it in a smart way. We didn't leverage and just trying to leverage things, trying to leverage for more returns and blowing up. We leveraged in a way that wasn't going to do it. We did it in an intelligent way by decreasing our risk first and then leveraging. All right, so recapping, let's kind of go through all the important stuff. Leverage, using extra money to make more money. Nice and simple, right? We talked about that. What are the interesting results? Leverage without reduction in volatility is a sure way to go broke. Okay, you go broke in 2008 if you just leverage the S&P. If you're just, so that's why you've got a hedge. That's why options traders have crazy things with puts and things like that. So, anyways, all right, you can make more money with less risk when leveraging, by having less volatility first and then coming in and leveraging. We can actually increase the return with less. And then we can leverage the leverage by overlaying mean reversion. We can get on a stable strategy, on something that's consistent, right? Doesn't have these huge nasty spikes, right? Something that's actually consistent, and using mean reversion around that, we can actually enhance our results, get more efficient with less statistical risk. All right, and with that, I'm all done. So may your assets grow and you sleep well. We can open it up to questions. I saw some kind of show up, so we can kind of dig through them and we can have a good time. So go ahead, Tom.
Oh, yeah, I mean, I can read them if you want, but Rick says he's a subscriber, and the weekly rebalancing gets to be a bit much. He's wondering if you could do a bi-weekly rebalance.
Yeah, so that's a great question. In fact, so there are some subscribers that have felt the same. They kind of monitor the allocations and say, hey, can I go to a bi-weekly or something like that? So just to kind of go through my thought process and how it kind of worked. I originally was doing, I originally had looked at the sleep health portfolio many years back to do something like on a monthly basis, right? Because that kind of made more sense. I wanted it a little bit more sleepy, right? And it works, but you do take some pretty significant intra-month risk on some of the big macro shifts, right? So there is something to that. So I mean, there are some subscribers that kind of check in on the allocations and see if it's been a decent shift, and they'll either leave them the same or they won't, right? Because it does work better for their lives if they're just kind of like, hey, you know, what is it this week? It's fine, I'll just leave it, right? Now I manage it once a week because it doesn't take me long, right? I just kind of throw in the I throw in the numbers, click a button, sell, boom, it's 5 minutes, I'm kind of done. But checking it once a week for some lifestyles doesn't quite work that well. So if I was going to do that, if I was going to try to spread out the amount of time in between reallocations, which can be done, what I would say is still just at least check in on what the allocations have done, right? Because I do shift them every week. And if it's a pretty decently large shift, it means that there's been a big shift in risk, right? There's been we had it a couple of weeks ago, which didn't end up turning into anything crazy, which, you know, thank God for the markets, but it was a pretty big risk shift that got us into something that we went really, really defensive. So when something like that happens, you definitely kind of want to pay attention to it. So that's what I would say. Sure, but just look every week anyways. You don't necessarily always have to hit the button. If you don't choose to, you are going to deviate from my results though. So.
Oh, and he says, my point for the question is that I run monthly portfolios, so I want to run leverage on a bi-weekly basis just to add juice to his entire portfolio.
Can you repeat that?
Yeah, so Rick said, so it's a clarification, is the point of his question is that he runs monthly portfolios, but wants to run a leverage on a bi-weekly basis just to add more juice to the entire portfolio.
Yeah. I mean, definitely the same concepts probably go by. And I mean, I'm not looking at the portfolio. I'm not looking at what you're doing. I mean, if you're doing it like the sleep well portfolio and you're doing it kind of monthly and you're wanting to do some sort of leverage, then yeah, being a little bit faster is better on that leveraging sense, just because you're going to be increasing that volatility. So checking in, amping up your frequency is also going to typically behoove you as long as you're not going too frequent, right? You know, that's something like with the sleep well portfolio, is that back when I was first creating it, you know, kind of going down into like a daily rebalancing, which I know is kind of crazy, but you know, ETF trades for most brokers are free right now, so you can do that. But it gets a little crazy and actually can start hampering returns. So you're definitely smart on one sense of increasing frequency. I think that would be better. I would definitely probably not go underneath a week if you're running something like the sleep well portfolio, but it definitely could be done. I would definitely, monitor your results. You sound like you know what you're doing. So definitely look for if you're deviating too much or if you need to kind of amp up the frequency depending on how much leverage you're using.
And Rick says, thanks.
Yeah.
Let's see, Nathan had a question. How would the LUHW, the high water strategies, work starting from a 2x basis?
Starting from a 2x basis. So the leverage under high water, so I mean, I don't have those numbers right off because I mean I've got to run through the results and kind of pull that out and kind of leverage it differently because there's different ETFs. But just kind of thinking through in my head, the thing is that if you start off from a 2x, then you've only got 3x from there to go, right? So then what you're most likely going to do is you're going to decrease your return, or you're going to decrease your standard deviation a little bit from versus a 3x. You'll probably outperform a 3x, but in those deep drawdowns, right? You know, because you're probably going to be leveraging from 2x to 3x in a very small drawdown, you know, probably like somewhere around 1% or so. And then you're going to be back up to 3x and boom, you're going to be taking off from there. So something to kind of keep in mind is that in those big drawdowns, you're still going to be taking about the same, but you are going to get more efficient using the same concept, but you've only got two levels, you know, 2x and 3x. unless you're more advanced. If you're more advanced and you're using like in the money options or something like that, or verticals or something like that to get even more leverage, which is something that's feasible. I'm not going to get into that today, but yeah, you could do something like that to get further, and you could do 2x, 3x, and then maybe something like a 5x or something like that.
Okay, and then in the Q&A, we had somebody ask, how about pulling the profits monthly to retain the basis amount, and then if that dropped that month, add back to the basis level?
Yeah, absolutely. It's a mean reversion strategy. Those types of things we can always, kind of dig into. And there's been a few things that have been pitched out on the forums. And actually, that's where even the leveraging during drawdowns came from, was someone had asked about it. And so it was like, okay, let's kind of dig into that. And so I work on those. So, anyone that's part of the service gets answers to those things if they ask. And if you've got an idea and it's got decent merit, and I start kind of working on it, it does take me a while to kind of dig everything out and kind of create the code for how it's going to be moving assets around. It in theory, it definitely is going to reduce the risk. I don't know, because the sleep well portfolio tends to trend sometimes, right? So we'll get on a rhythm and we'll just go, right? It can have its thing. So like right now, the sleep well portfolio had a really booming beginning of the year and end of last year, right? And then it's really kind of, calmed down, right? And that's pretty usual, right? Sometimes we go, 6, 7, 8 months or something like that. Anyone that's an options trader kind of knows some things just kind of, peter out for a little while. But then you'll have like 2 months that'll just be like all of your returns for the whole year, right? And it'll be amazing. And like, thank God we are in, right? So on certain strategies, something like what you're talking about, if you're decreasing the amount of money and keeping the same pool and then kind of building it in during drawdowns, it will affect those kind of trendy spots. So when you add in is going to be kind of crucial. So I did do a strategy on the older version of the sleep well portfolio that did an allocation based, kind of what you're talking about, right? So at high water mark, you basically take your allocation from 100%, you chop it in half, right? So you're in essence deleveraging. You're not using a leveraged asset, but what you are is you're taking on capital out of it, right? And then during a drawdown, you'd put that capital back in. And I did do that, and it did enhance the results and created significantly more efficient. Just you did give up results by that because you just don't have money invested all the time. So it does hamper the returns, but it does make it significantly more efficient and more stable. So if you're looking for stability and you're looking for, you're not necessarily chasing returns, but you're wanting to be more efficient, that would be a way to go.
Okay, and let's see, another question in the Q&A, or hedge the 3x ETS with cheap reversion butterflies.
Okay, so there's someone that's a little bit more advanced there.
Yeah.
So yes, yes, if you're familiar with butterfly strategies, if you're familiar with beta weighting, if you're familiar with those types of things, you can definitely overlay it. There are subscribers that use the edges that they're familiar with and base things on the sleep well portfolio, and they've had great results. So the service itself, right? I run a 1x so that everyone knows where the baseline is, right? That's what I publish. That's where I'm showing things. That's what the results are when you look online. Tom, you update the 2x and 3x variants on the page that I'm sure you can throw a link in the chat or on the video if you're watching the recording. And so you can see kind of what a 3x has done since the beginning. So those types of things, but I do run a 1x for the base variant. So that way everyone knows where the drawdown's at, everyone knows where things are going. So that way, if they're using some of these esoteric strategies or they're using butterflies and things like that, they kind of know what to do. So yeah, that's whoever's doing the butterflying and doing that, when they know what they're doing, they're going to be able to get significantly enhanced results because that butterfly is an extremely leveraged asset, and you're getting a little bit of theta premium depending on how they're running it, right? So you can get dramatically better results than a 1x. I mean, you're talking now into the 100 annual return, something like that. So anyways.
And that's it. I don't see any more questions or comments.
All right. All right. Well, it was a great, it was a great time. It's always good talking to everyone. And I really hope that everyone learned something from this. So yeah.
All right. Well, thanks, Wayne. The leverage definitely improves things, and I'll get this recording on as soon as I can for everybody in case they missed it. But
Fantastic.
Yeah, look forward to continued growth with the sleep well.
Heck yeah. May the good times roll for everyone.
All right. Well, thanks everyone for coming, and we will see you next time. Thanks, Wayne.
All right. Bye, guys.